As a new trader, it can be difficult to understand how experienced traders are able to analyze complex graphs. So in this section, we'll learn about market structure, which is the foundation for everything else. We will also cover other important topics, including different types of structures, how to map them, and concepts like strong and weak points in the market. Before diving into the advanced concepts of trading, it's important to have a solid understanding of market structure. So in this section, I'll provide a quick overview of the basics of the market structure to help set the foundation for further learning. When you open a blank chart, you'll see candles moving up and down. These movements are the result of supply and demand in the market. As buyers and sellers engage in trades, the charts will reflect the changes in price. These moves of price create historical data that can be analyzed to identify trends and patterns for trading purposes. When it comes to the Forex market, understanding the direction of price movement over time is crucial. This is where trends come in. In the Forex market, we have two types of trends, bullish and bearish. A bullish trend, also known as an uptrend, is characterized by a series of higher highs and higher lows. This means that over time, the price for a certain currency has been rising. When the market is in a bullish trend, it's considered to be in a state of buying. On the other hand, a bearish trend, also known as a downtrend, is represented by a series of lower lows and lower highs. This means that the currency price has been falling. When the market is in a bearish trend, it's considered to be in a state of selling. So being able to recognize these trends is important for understanding the Forex market and will help in later concepts like structure mapping and analyzing multi-time frames. The Forex market is constantly moving with prices pushing and pulling back. It's important to understand that these movements will continue until it fails. In this lesson, we'll take a closer look at how to spot these movements in price and what happens when a price movement fails to achieve its goal. First, let's define the terms. Swing highs and lows are the large highest and lowest point of a movement. These points are created when a structure is broken, which we refer to as a break of structure or a boss. We determine that a structure has been broken when a candle body closes above the recent high in the particular time frame we are using. For example, in a bullish trend, we have a push followed by a pullback and then another push to break the recent high of that movement. The low where the push originated is the swing low, and the top of the push is the swing high of the movement. After the pullback is finished and we continue the movement to break the recent high, the lowest point of the pullback will be the swing low, and we'll wait for the next pullback to determine the next swing high. It's important to note that we use this mapping to understand where we are in the market and where we should expect price to go next. This helps us avoid getting caught on the wrong side of the market. In addition to understanding market structure and how it moves by making new highs and lows, it's also important to understand the job of each movement and the expected order flow. To better understand this, we use two terms, strong or protected points and weak or targeted points. So let's take a look at the charts. In a bullish market trend, the job of the strong low is to break the weak high. And in a bearish trend, the strong high's job is to break the weak low. As you can see, when there's a push and a break of structure, we expect that when price pulls back, the strong point of the move will be protected, allowing price to continue breaking the weak point. As mentioned earlier, we should expect the order flow to continue until it fails. If the strong point fails to break the weak point, instead returns to break what was the strong point before, we can switch our bias accordingly. The point where price failed to break is now our strong point, and we should expect price to pull back and continue the new order flow. This concept, although simple, is crucial to understand how price is moving and reacting to structure. We will be using all these confluences, such as market structure, breaks of structure, and fail points, to build a high probability analysis to know where price will head next. This element will also be part of our trading plan and will be covered in more detail in future lessons.